Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we're going to be analyzing Wells Fargo stock. This one came in by request down in the comment section of one of my other videos. If you have a request you would like me to make a video of, just drop it down in the comment section. If it's a stock that's in the S&P 500 like Wells Fargo is, I post those on YouTube for free. If it's not, I post those on Patreon, which is $5 a month. And if you join Patreon, you can get a big discount to my full Cyclical Investors Club service over on Seeking Alpha, where I have chat rooms and spreadsheets that you'll often see here. Lots of other articles, lots of investing strategy stuff there, and you can basically chat with me anytime. And those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. All right, let's get into Wells Fargo. Where should we start here? Okay, so I think one of the reasons that people, well, there's a couple of reasons people are interested in, have been interested in Wells Fargo over the past like 15 years. One is they remained profitable during the Great Recession. As you can see here, they, unlike a lot of banks that actually lost money, some of them actually went out of business and so forth, Wells Fargo did relatively well. Also, Warren Buffett bought more Wells Fargo at this time, down here near the bottom, and then he held for probably about at least 10 years or so, maybe more than 10 years. And it had been a long time Berkshire Hathaway position, but he really loaded up during this crisis. It's also a well-known bank, so people are aware of the brand. It's not just a regional bank nobody's heard of before. It's a national bank. And I think that's probably what interests people initially. And it's in the S&P 500. It's well known. Also, the PE is like 10 right now, which is pretty cheap relative to the rest of the market. Let's see if I can get rid of that now that which is probably, the PE is probably double that. So the question is, does that PE make sense? So there's a simple metric that I have used to track Wells Fargo that has kept me from buying the stock. So during the 2020 crash in March, I bought maybe like 5 banks. Wells Fargo was not one of them. And then I bought one bank during the 2023 crash in March here, which was actually one of the same ones I bought here that I took profits in. But Wells Fargo, again, wasn't on the list. So for me, the simple reason that Wells Fargo wasn't on the list is because at a point in here somewhere, their 3-year cumulative revenue growth went negative. And once that happens, the stock is a sell for me if I own it, and unless there's like an explanation, right? If it would, this particular time right here, there might have been an explanation for like revenue growth dipping, but it happened before then. I forget exactly what year. I'll look at the bigger graph here in just a second. But basically, once that revenue growth tipped negative, that is the sign on a slowly growing or mature business mid-cycle with no other explanation. That is a sign that competition is catching up with them, or they just can't grow anymore, or if they got too big, whatever. It doesn't really matter what the reasons are. If a company's revenues 3 years from now are lower than they are now, that's not usually a stock I want to own if there's not like a macro explanation for it, right? So that's why Wells Fargo's always been in a void, and it's always pretty much been, hasn't always been a sell, but it's mostly been a sell during this time. So let's look at that metric real quick. So I just put up a couple charts here. So now this is the current 3-year cumulative revenue growth, which is 9%. Now that's not good, but it's positive. So, but what you need to remember is we came off that trough of 2020. That's where this starts at. So this is really kind of a best case, like the actual timing of the 3 years happens to fall, the beginning of it falls at a trough, so it's making Wells Fargo look a little better than they actually are. So it's worth looking at a longer term chart just because I know what it was before, and also comparing it to like some other banks. So this is a 10-year revenue graph. I probably should have put another 3-year that compared all these two. But if you look at the lines on them the last 3 years, these are big positives, big positives, big positives, decent positives. Okay, and then we get down to Wells Fargo, which is just barely, I think it probably that graph started right there where you got the 9%. So you can just visually see how weak it's been relative to other banks during the past 3 years. But this goes out longer to 10 years and we can see the bigger trend. Wells Fargo and Citigroup are basically flat on revenue. Now, this is a time when inflation is probably 14? Since 14? Might be 30%. So you have 30% inflation and their revenue is flat. So that's not good. If you look at the other banks, they're about like, let's see, we have US Bank here and PNC. So I bought both of these during the March 2020 crash, and I've sold them both since then. But you can see that over this time, I mean, this is nothing spectacular, but their revenue is keeping up with inflation, and you get a little extra on top. So that's what you want. Bank of America, another stock I haven't bought because they really haven't, they've recovered since the banking crisis, but I don't think they've fully recovered, maybe just recently. I haven't looked at them. They've kind of been on my just pay no attention to list for a while. So before I say anything that people blast me for in the comments, no, I'm totally right here. So their earnings have recovered off the bottom. The prices recovered off the bottom, but it still hasn't reached 2006 levels, right? It was $54 a share, and now it's half that still, like 15 years later. Earnings were like, what does this look like? $4.50-ish, and now they're only like $3. So it's never recovered from the past. Now, if you bought it down here, you're doing fine, right? But the business itself is just slowly trying to still recover, and we aren't even in like a recession yet. If we have another recession, it could go on and on. If you look at Citi, it's even worse. Again, see, boom, that's even worse. So now, if you're the type of person that likes to try to invest in turnarounds, then you could, and Wells Fargo is better, it looks better than kind of those to some degree. They were steadier during the crisis, but Bank of America has grown more the past like 10 years, right? So there's a little difference there. But they also had like ethical problems at Wells Fargo, I mean, when you're ripping off your customers, that's not good for business once you get caught. And it's pretty hard to, once you've created a culture like that, to change that around. And there's a bunch of other banks you can buy. So, I mean, for me, this is just, they might turn around, but is the upside really going to be that much compared to a different bank? So when all banks trade similarly, there's no sense owning the bad ones or any with any ethical problem, sell. With any inability to recover, sell or don't buy. I mean, that's just me. And then I move on to the ones that actually have a good track record. So if you look at the ones that I bought, we'll look at US Bank, which I almost bought again in March, and then it didn't quite get to my very conservative buy price. I think it was $2 away. Look, decent, okay growth, and then we get in this choppy area. So they're going to have to try to come back out of that. But if you bought down here, you're doing really well. Even if you owned it in 2007, the worst time to own a bank, and then during this decline that they're in now, you would have at least gotten inflation out of it, right? That's like picking the worst times pretty much. I was able to buy down here and I got a double off of it before taking profit. So if we look at PNC, which is another one, it's bigger, so it's probably closer to Wells Fargo than, again, really good earnings performance during the financial crisis, good earnings growth. The spike was when they sold their BlackRock stake, and then so I took profits in this one too, bought it down here, took profits up here. Almost bought it down here. It's another one I would buy again if it was cheap enough. But you just don't have all the problems. You have similar sort of structural upside potential. So, I say buy the good ones, and when certain ones mess up, then I just stay away from them. there's too many banks to be locked in on any one, and it's just not the type of thing where I'm looking for individual turnaround type things. Banks usually, especially the regionals, they trade together. If you pick a random regional bank, it's going to trade very similar to the other ones. So you want, if you're going to do that anyway, you want to own the best ones when they're cheap. So that way you might not be able to increase your reward, but you can decrease your risk that way to some degree. And then using history as is the not always the best risk adjustment, because sometimes a bank will start taking risks that they hadn't taken before and so forth. But it's a pretty good one. I would say if I can tell that they've taken risks in the past, and that like in 2008, then I'm not giving them the benefit of the doubt. I'll find a bank that didn't take those risks, because my chances, we don't really know what the risks are until the banks screw up, until they tell us that they're going bankrupt. So, which everybody got to see last March. So you just try to kind of pick the ones that make the most sense, and then that are the safest when they're cheap. And you avoid the ones that look cheap that might have any kind of issues or struggle with growth or whatever you have. So that's my thinking on Wells Fargo. It's an avoid for me, unless a person really can figure out what is going to actually make this turnaround happen without them taking on risk. You can see their earnings were actually more cyclical during COVID than they were during the financial crisis. So that doesn't COVID's a weird situation, but that doesn't necessarily give you confidence that the next downturn isn't going to be bad for them. If you compared them to PNC, might not be the best one, but look, their earnings barely moved. Well, that's not really fair because of their sale. Maybe US Bank. So they took an earnings dip, but it wasn't that huge one that you saw from Wells Fargo, right? So anyway, that's just how I think about it, and how I think about banks and investing in banks. Buy the high quality, buy them cheap, and don't get greedy, because they are usually at least somewhat cyclical, and some of them are deeply cyclical. All right, if you enjoyed this video, click the subscribe button, hit the like button, drop your requests down in the comments. I'll get them on the whiteboard behind me, and I will make a video for you. See everybody later. Bye.